Welcome to More Bank for Your Buck. I'm Erol Kinkaid. This is episode 4, and we're joined with Phil and Jim Brock out of our wealth banking division. Jim, welcome.
Thank you. Thank you. I can't help but notice I am the only guy here with gray hair. So,
and we're thankful for that.
I'm working on it.
I've got gray in my beard thanks to 3 young kiddos. And anyway, the topic for us today, we're going to be talking about the market, investing, and that's Jim's area of expertise. But before we do that, Jim, let's maybe a greeting to our viewers and a little bit of background on you and how you got into banking in the financial sector.
Well, it's never a direct path when you get into business. And I graduated from the University of Nebraska, and I actually went to school to be a veterinarian, believe it or not. And I had a degree in chemistry and biology. And I figured out that the path to veterinarian school was pretty difficult. Back in the day, back in 1978, Nebraska was going to get their own veterinarian college, and they never did. So you would have to transfer to another college. I had 3 buddies. They all went to school, all became good veterinarians, but not one of them worked in the business. So when I got out, I started, and I started not in the financial industry, but I went to work for IBP at that time, who was the largest meat producer in the world. It's Tyson Foods now. But I worked up in Dakota City in corporate. Once I left IBP, which was brutal, by the way, that's a tough company to work for, but I ended up in Omaha, and I had a friend that hired me to work for a division of Amical Oil, believe it or not, yeah. They had an office in Omaha, and we did what was called structured settlements. And for those that don't know what that is, whenever there's a big settlement, they did a lot of big liability claims, and whenever there's a settlement, the attorneys, the people that are involved, the plaintiffs, we would structure a settlement. In other words, they would get part of the payment up front, then you would give them payments over a lifetime. So that's kind of how I got exposed to it. We worked with a lot of structured settlement companies. After that job ended, I ended up going to work for a financial firm out of Des Moines, was traveling and calling on agents and brokers. After that, then I ended up with kind of the tail end group with the United Nebraska Bank as an advisor. And then when they were bought by Tier 1, I came to Equitable. So I've been on the advisor side about 30 years now. So,
Jim, 30 years of history advising individuals, clients about their money. What are the markets doing? What should I be looking at? How do I start investing? A question I get often with customers is, say they've got a business and they're doing really well with their business, but one of the downsides of being a small business owner, unlike Erol and myself, when you go to work somewhere, they sign you up for their 401k program. Right out the gate, you're signed up for your 401k. Oftentimes contributions start soon thereafter, whether you sign up for them or not. But as a small business owner, I've run into several individuals who are well into their career, have a very successful business, and they've never touched the stock market. They didn't have a 401k for their business when they got there. They started their own business. And they oftentimes ask me, well, I feel like I should be doing more. I've got this great business. We're building equity. We're making money. But I'm not really saving for retirement. My retirement is my business. I'm hoping I can sell this business at some point, but I feel like that I'm maybe a little bit concentrated in this business or in what I'm doing. And they want to know, well, how do I even get started? And of course, in times like today, slightly turbulent, volatility has returned to the market. We've got stocks down, bonds are down. It's not very often that we have both of those moving down in tandem together. If someone walks into your office today, Jim, and says, I'm 42, I'm 28, whatever age it might be, and I've never started investing in stocks or retirement, how do you get started with them?
well, sooner is better than later. That's the first thing. And you're right. We see this a lot, especially with business owners and somewhat with ag producers. they look at their retirement, either their land or their production or their business, but they're not diversified. And there's all kinds of programs, retirement programs for small businesses, specifically for small businesses. They can start on a small scale. They don't have to be in the stock market. I think that word stock market scares a lot of people because they look and they see this on the news and they say, oh my God, the stock market. We use mutual funds. You can open a retirement account on the bank side and put your money in an FDIC insured product and have a retirement account, have it shielded in a retirement account. But I think you start off small. Somebody that's 40 years old, they've got another 20 years. They've got plenty of time to start investing. The best place to start is when you're in your 20s, as soon as you can. And I think we're doing a better job as an industry in that we are trying to, a lot of the changes in retirement now with automatic enrollments and those types of things for plans. I think it's great because people are not saving enough for retirement. The next crisis we're going to see are retired people that can't support themselves. And we're starting to see that now. When I started in this business, $100,000 was a lot of money. And people would come in and say, I have $100,000. You'd say, oh, you got it made. $1 million now is not a big sum of money. It looks like a big sum of money, but if you look at the longevity of people, the expense, and look at where inflation is, just the cost of things, $1 million is probably where people should be, and people say, well, I'll never get there. Well, at least you got to try. I mean, you gotta do something. And the earlier you start, the better it is. It's the time value of money, small amounts of money over a long period of time.
Right. Jim, one of the things I was thinking about as I was coming out to Grand Island today was the volatility of the market, but how important is goal setting? When you're sitting down with a client, regardless of their starting point, right? Maybe they've only been investing for a few years, or maybe they've been in the game for a while. Talk to us a little bit, and maybe our viewers, about the importance of that long-term goal setting and kind of that vision casting, right? Of where do I need to be, and how that impacts your discussions and strategies with your clients.
Great question. As far as goals, there's different. I look at money as just a tool. A carpenter looks at his hammer and his saw as a tool. Money is just a tool to get you where you want to go. And when we talk about goal setting, there's various goals. Is it retirement? That's the number one goal, I think, of most people. The next biggest one is college savings. I got kids, maybe it's saving for a house. We talk to them about that because we have different buckets of money depending on the goal. We want to know where they're at in their life, what they need the money for, and how we allocate that money. Long-term money for retirement, that's going to be different than maybe money for college that you're going to use in 10 years, or maybe money that you're going to use for a home within 5 years. We would never put short-term money in the market, regardless. If you're looking to buy a home in the next 3 or 4 years, that money shouldn't be in the market. It should be someplace safe. But that's a goal, and we're going to advise you to allocate that to something very conservative, something that's guaranteed. So goals are important. I think the biggest goal for most people, though, is retirement.
When you talk about retirement, to me, people always, they have this kind of this historical view of retirement as you turn 65, you get the gold watch, and you ride off into the sunset, going golfing every day, or whatever your passion or your hobby it is. But to speak to Erol's point of goal setting, retirement for you, Jim, and for Erol, and for myself, those are all three entirely different things. And when you talk about setting those goals, if your vision of retirement is, well, I like to fish and I like to garden, and I'm not much of a world traveler, I don't have a lot of debt, really, in planning for their retirement, they could be a lot more conservative, or maybe not as aggressive on as much money as they're putting away. At the end of the day, it's how wealthy do you want to be at the end of your working career? But what determines that is, what do you want your retirement to look like? If you want to be jet setting around in retirement, traveling to Europe, going all over, doing all these things that you wanted to do throughout all your working years but didn't have the time or the money to do it, then you do need to have what might be a more aggressive retirement savings plan compared to the individual that says, my family's all around here. I don't have a lot of expensive tastes and hobbies, and my lifestyle is fairly modest now, and I just want to continue that. I mean, really, to me, that goal setting, it's more than just a number. It's what is your vision for retirement? Some people, I think we all know a few people that they work well into their 70s because they just love what they do. So, their plan for retirement looks a whole lot different than that person that's counting down the days to 62 or 65 or whatever it might be.
Yeah, everybody's different. There are some folks that are happy on a very, very meager retirement. And that's great. I think that's wonderful. And there's other people that they, if they have $1, they're going to spend $1.50. But even with goal setting, you talk about, should you be more aggressive with those people that are the jet setters? I think it all boils down to risk, not only goals, but risk. When you're somebody my age, I've got a lot more years behind me than I do ahead of me. My risk is a whole lot different than yours and Erol's. And certain people can tolerate more risk than others. That's one of the big things we do in goal setting, was look at what's your risk tolerance. Can you stay in a plan that may fluctuate 20% in a 5-year period or something? Some people can't do that. Well, we're not going to put you in something, even though you have a goal and maybe it's going to take an aggressive portfolio, but you don't have the risk for that, you're not going to get that portfolio. You're going to have to learn to pull back, maybe live within your means. And people always say, well, how much do I need for retirement? I'd say, well, as much as you can. And, there's never too much for retirement, because if you have too much in retirement, you just take a bigger vacation, you spoil the grandkids more, there's always ways to spend it. The tough ones are the ones that spend and they don't really have. That's when we start talking about budgets. Because another thing we talk about, and we're seeing this more and more, is how long is your money going to last? It's a finite amount of money, and if people live 30 or 40 years, my in-laws are 101 and going to be 100. They have lived on this earth a century. Their expenses now are probably higher than at any time in their life. They lived on the farm for 90-some years, lived like church mice, but now the cost of health care and that type of thing has caught up with them. But I think when we look at that, we need to talk to people, and we do a lot of this about withdrawal rates and what are you spending. And I'm not shy to tell people you're spending too much money. I know you want to do this, you want to help the kids, you want to take this trip. We've got to have a budget, because you're in jeopardy of running out of money. And that is the worst thing in the world, is to run out of money in retirement.
Well, and I imagine now you're probably having more of those conversations than you were, say, 6 to 12 months ago, when the stock market was on the epic acceleration out of the doldrums of COVID. If we think back, March of 2020, the market goes into a historically quick bottoming process, because nobody knows what COVID looks like. And we do get the V-shaped recovery because of an unprecedented amount of stimulus that the United States and other developed economies around the world inject into the financial system. And for as long as I can remember, stocks have gone up. I remember the GFC in 08 and the bottoming process there. But it seems like the bottoming in COVID was such a blurb. I hardly remember the stock falling at that point in time. It was just so quick that we were already on the path to recovery, and it seemed like everybody could see the light at the end of this tunnel. You've been around for some cycles, because it doesn't always go up. There are longer term cycles. There are such things as bear markets that last several years. And as you're having these conversations with people now about their budgeting and about saving for retirement, I mean, in my mind, if you've got some spare money or you're wanting to get started, there's no better time than the present. I mean, if the market's down 15% right now, stocks are on sale, in theory, from where they were. Now, it could still be historically expensive, or however you want to look at it, but I think it goes back to that time horizon you talk about in your goal setting. So are we having more of these conversations today now that we are experiencing more volatility in the market? What's the overall attitude out there?
Well, anytime the market goes down, there's more anxiety out there. And you talk about stock market cycles. When I had started my new career when I was in Omaha back in 1986. And in 87, and you guys are all too young, you were just a twinkle in your mother's eye back then. But in 87, in October, the market dropped 22% in one day. And I remember it because, and this is going to really date me, but I was sitting at the Breaker Brandeis building in Omaha, Nebraska. I don't even know if the building's there. It's the old Brandeis building downtown. And we were sitting around and everybody was looking at each other like, well, what are we going to do for a living now? Because we knew what was going on, but nobody else did. Because there was no cell phones. There was no internet. I mean, the communication was, we knew what was going on. At lunchtime, some people would say, hey, I saw at lunch that, the market's kind of rough. People went home at night. They saw it on the news, and it's like, oh, wow. I think now what happens is that the bad news is always exaggerated, and that makes our job a lot harder. But people have to be focused on a plan. Is it a plan you're going to stick to? And we do not, we don't make a lot of big changes, to say, oh, we're going to try to get out of the market, then get back in. I saw this especially in 2008. People gave up on the market. They got out and they said, well, I'm going to get back in when it gets better. I don't remember what the exact numbers were on the market in 2008. I think it bottomed around 6,500. Let's just call it 6,500. Those people, a lot of those people that got out never got back in. Look at what they've missed since that time. We've gone from 6,500 to 35,000. They've missed some of the greatest economic growth in the history of the world. The other thing I think people forget is that economies are designed to grow and produce. Does that mean that they always go up? No. But they are designed to continue to grow. We innovate. We have goods and services. Even in 2008, people thought the world was ending. People still eat. They still fill up their cars. They still go to work. Regardless of all the noise, you're still going to live your life, and the economy is still going to go on. We got to the point that, and we saw this in COVID, where people just panicked. I mean, they really got scared, and I'm not diminishing that. That anxiety was real. But I remember one gentleman came in, and he had a small account, and he said he was going to cash it all out. And I went over the tax consequences for him. I said, well, what are you going to do with the money? He says, I'm going to take it home, put it in a safe. And I says, the term sheltering in place had never been used. That had just come out, sheltering in place with COVID. And I said, well, what is that? And he says, well, you go to your house, you lock down, and you save yourself from this Black Death or whatever it was. And I thought, well, that's really not the way I want to live. And I said, well, what good does that money do you if everything goes to pot? He says, well, I have this money. I said, it's just paper. I said, have you ever seen the movie Titanic, where the guy with a wad of cash is trying to buy onto the lifeboat? Why would you want the money? Because it doesn't do you any good. If things are going to get that bad, and when people are irrational, I use this example. I said, if things get that bad, we're all in the same bathtub. It doesn't matter where your money's at. It's a digit someplace in a brokerage account or in the bank. If things go to pot, it doesn't matter if you have cash. I would rather have bullets and bottled water and a little land to survive on if it's going to get that bad. But I don't believe that's going to happen. I still think we live in the greatest country in the world. We have the best economy in the world. And no matter how bad that the government at times can screw it up, we still come back from it. And I still believe that now. Will we get through this? Yeah, whatever it is. I don't know if we're headed towards a recession or whatever, but I think people have to keep in mind that economies are designed to grow, and that's generally what they do. And there's times when they don't, and we're in a kind of a slack economy right now where the results are mixed at best.
Question on that too, and just kind of people's thought processes, right? In uncertain times, anxiety's high, stress levels high. There's a lot of uncertainty. That's not the time to be making quick changes to long-term investment strategies. Maybe speak into our viewership a little bit in regards to, how and when should we be making those types of sometimes reactionary, but hopefully a little bit more proactive changes in that thought process and how you try to coach or walk clients through that process. Because I think there's a lot of people going home right now thinking, I need to make some changes. I'm scared. I don't know how my accounts are set up. I don't know what's going to be working now that there is so much volatility.
I think a lot of times clients think if you make changes, you're doing something. And I saw this in the dotcom bubble, if you remember, in 2000. Anything with a dotcom behind it just blew up. I mean, there was companies out there that just they went public and they had a dotcom behind their name, and they, I mean, it was just incredibly how these companies just exploded. Well, once that imploded, then and they all went down in value, people were really, really stressed. But I think, getting back to your question, it all starts at the initial process. And I don't think we make changes just to make changes. Sometimes the best thing to do is nothing. And I'll tell you, in 2008, I told a lot of clients, or advised a lot of clients, we're not going to do anything. You've bought good quality. This is appropriate for you. We're going to ride this out. And they didn't like that. They didn't like it at all because you're not doing anything. Well, we're hunkering down here. The worst thing you can do is make an irrational decision at that point. But I was proven right, and I think most advisors that had people stick to a plan, they did very well. Once we got through 2008, by 2010, the market had taken off, and we've been on a roll since. But there was a lot of folks that got out, and they lost a lot of opportunity.
Well, and to speak to that, in preparation for this conversation, I grabbed some fun facts, and I pulled this off of Yahoo Finance. I just pulled up an interactive chart of the S&P 500 going back to particular dates. And when you talk about when people get anxious, and we're all the same way, we're all wired very similarly in that when there's turmoil around you, you feel the need to do something because it gives you this artificial feeling of control. Okay, March 2020 happens, COVID's coming, we're locking the country down. The people that want to take all their money out of the market, put it in cash and hide it under the mattress, it gives them a semblance of control. No different than running to Sam's Club or Costco and buying every shred of toilet paper you can find so that we can weather the next 6 months at home. But to Erol's point, it's that exact peak moment of irrationality that is so important to have that long-term plan that you established on your own with your financial advisor in a calm, rational setting. Because to speak to what you said, if you would have invested, say you inherited $100,000 from Aunt Mabel, just a windfall of money, and you don't know what to do with it. And it's January 1st, 2020. COVID is really just starting to hit the news waves. It's in China, nothing local yet. We really haven't heard what's going on. And the stock market at that point in time is trading at, for the time, all-time highs. If you had put that money in the market in January of 2020, as of right now, you're still up 24% from January of 2020. You rode the catastrophic drop, and you would have felt horrendous at that point in time because you just put all this money in the market. But yet, had you stayed the course and just left the money wherever it was in the S&P 500 or whatever your allocation is, the S&P is up 24% to that same effect. If on January 1st of 2007, right as the GFC is starting to kick off, we're starting to see some defaults tick up in the home mortgage, the subprime crisis, most people would say that was not a great time to invest in the stock market. Without reinvesting dividends, you're up 283%,
Right.
almost a tripling of your money. In going back to the dot-com bubble, 351% had you invested Aunt Mabel's $100,000 on January 1st of 2000. And the best quip I've ever heard about trying to time the market is it's not just knowing when to sell, it's knowing when to get back in. You have to be right twice. It's not just
right.
because like right now, I mean, you cannot turn on any type of news program, whether it's Good Morning America, CNBC, MSNBC, Wall Street Journal. Every major news publication has got pundits talking, bringing in economists who are infinitely smarter than myself, saying that a recession is coming. Jamie Dimon last week comes out and says there is a storm coming. You have all these people telling us the recession is coming, and it very well might be. But the one thing they never post is the people's talking current stock portfolio and to see if they're really preparing for this storm and this recession that they know is coming by going to all cash or all ultra secure investments, because I feel like that, as you said, that negative narrative, it sells. That gets clicks, that gets viewership. But at the same time, it's doing a huge disservice to the general public who watches that and then goes home and says, am I doing something wrong? Do I need to be going to cash? Do I need to be liquidating my portfolio? And if you're 87 years old and only have a couple years left to live, that might be a different discussion. But by and large, for the average human who has a runway yet ahead of them, or working years or whatever it might be, that could quite possibly be the worst thing you could do.
Well, fear is one of the strongest emotions people can have, and we recognize that when folks come in, they're scared, and our job is, first of all, to kind of bring them down a little bit, to snap them back to reality and say, we don't have a crystal ball, but we'll get through this. And we have. I haven't been wrong yet, but who knows? Jamie Dimon, I don't know if he's right or wrong. And these economists, if they bat 50%, they're lucky most of the time. If you go back and look at the predictions, they're lucky if they hit 50%. The other thing is, folks expect you to do something when there's a crisis. My dad was an Army sergeant, and he always had a thing. He would yell at us, and if you would panic, or he'd say, do something, even if it's wrong. He just wanted action. That's what and it was to snap you out of there. He would say that to his soldiers. You would snap them back to reality and say, do something, move, go. Well, I think folks look at the market and they say, what are you doing for me? You gotta, I'm listening on the news and it's terrible. What are we doing? Well, we're doing what we can, because there's not a whole lot you can do, because by the time the wave hits you, you're already wet. I mean, where are you going with this thing? I mean, you really don't know, because recessions, markets, they creep up on you. Who would have thought in January we'd be down 20% in the market on the NASDAQ or whatever it is? And who forever would have thought that bonds would be down 10%? We've seen something we haven't seen for a long time, that the stock and bond market have moved down in tandem. Usually that doesn't happen. But I think what folks need to realize is sometimes it's just the time in the market, not timing. There's no way you can time the market. Like you said, you got to be right twice. And if you look 365 days or 2 years or whatever it is, what's the likelihood? I'd like to see the statistics of being right on those to get in and get out. It isn't going to happen. So there is a commitment when you invest. It's different than savings. It is a commitment. It is a long term, and we talk about that. If that money shouldn't be there long term, we don't want to invest it. We want you to put it in the bank. We want it someplace secure, accessible. Money in the market should be long term. So the other thing is, I think people forget, especially now, the business has kind of moved to managed accounts, and they are managed by fund managers. There's fund managers underlying the manager of the accounts, and they are making changes. So when you go in there and say you want to disrupt this, you're really disrupting what they're paying, the client is paying to do, is to have them help manage the money. And who knows more than somebody maybe managing billions of dollars? Do they know more than you? I don't know. They probably have access to more tools than you. But by you making a decision to do something, you're affecting what they're trying to do. And I think folks need to understand that the actively managed funds, they are doing something. They're rebalancing. They're moving money around. They're looking for opportunities. And I'll say one final thing about this. Since the beginning of the year, there has been very, very few asset classes that have made any money. Name one that you think has made money, asset class. Just throw one out.
Energy.
Energy, perfect. That's the only one I could think of when I came here today, energy. Even minerals, you would think in a time like this when things get nervous, usually gold does well. Crypto's down. The only thing that's done well is energy. That has been the only asset class that has been positive this year. So that's kind of strange.
It has been definitely a year of strange occurrences. And I think one of the biggest reasons that we're entering into this new paradigm shift is we've gone from a easy monetary environment, basically starting with the great financial crisis. We started quantitative easing in 2008, coming out of the doldrums of the GFC, and have really ebbed and flowed. But if you look at a long-run chart of the Federal Reserve's cumulative balance sheet, it has one very prevalent direction, and that is up and to the right, which would signify loosening financial conditions. And for the first time in a very long time, inflation has reared its head, and now the Fed has come out and said, we are going to tighten because we need to stop inflation. Now, I've never experienced real inflation in my lifetime, and have certainly never invested through it. Could you talk a little bit to the fact that the Fed is saying we're going into a tightening cycle? And, is that why markets are changing? Is that the changing dynamic of the market? Or what should our clients, customers, investors expect as we move towards a tighter monetary environment?
Well, we have been spoiled, I think, the last 40 years, really, we've been in, maybe not 40 years, but we have been in a long duration of interest rates, low interest rates. I remember the first house I purchased in Omaha, we got a NIFA loan, which was Erol probably can address that, but it was for certain incomes and whatnot, and the government helped support it. I remember the realtor telling us she thought she could get us around 12%, and that was huge. In 1980, you could buy a 30-year government bond that paid 18%. You guys have never seen that. I mean, I've got family members that farm and in business. They've never seen interest rates above 5%. They think that is normal. Well, it isn't. The Fed's kind of got themselves in a pickle here because they kept interest rates low, and every president, every administration that comes in wants to see low interest rates because it's positive for the economy. Got cheap money, the economy does pretty well. Well, what's happened with COVID, because of all the stimulus money out there, they flooded the market with money. And what happens when there's too much money out there? What do you get?
Inflation.
You get inflation, exactly. So now we have something we haven't seen for years. And I remember back in 1980, my father-in-law was in the fertilizer business, and I remember every week he would go to a farm sale. He was losing customers, not because they were bad farmers, it's because they couldn't support the debt. At 18 or 20%, it was eating the, and I remember back then, they always said, there'll be no farmers anymore. It'll be all corporate. We'll have to have Cargill or somebody they'll farm all the ground because nobody will make it. Well, you couldn't survive at that level with debt. So I've seen what high debt does. It's terrible, but the downside of that is if you don't raise interest rates, then you're going to have this inflation. So they're in a pickle right now. We've got inflation, we've got low rates, they've got to raise rates, which impacts the market. You talk about the Fed, they've got to take down their balance sheet. So this is going to be a little different. We haven't seen this, I think, since the Jimmy Carter days. And when Reagan got in, if you remember, you don't, but when Reagan got in, he hired a guy by the name of Paul Volcker, and Volcker attitude was, we're going to make this painful, but we're going to get rid of inflation, and he did, and rates went up. What happened after that? Stellar markets, great markets, but there's some short-term pain in there. So as these interest rates rise, it's going to impact a lot of things. But we're sitting at $4 gas, which is worse, $4 or $5 gas or higher interest rates. I don't know. I mean, they're talking about a soft landing, and we use a lot of terms in this business. The Fed thinks they can do a soft landing. They can raise rates, keep the economy going, and avoid a recession. I hope they can. Nobody knows. Jamie Dimon, when he had that speech, he thinks it's just going to crash and burn. Well, I don't think Jamie Dimon knows, but who knows? We'll see who's right, but time will tell. But we are going to see higher interest rates. I think in the next year we're going to see rates probably move 1, if not 2%, maybe as high as that. It depends where this inflation goes.
I know we're coming up on the end of our time together, Jim, and just thinking back again to our viewership, what resources are available for them to connect with you and your team, one, and two, if they were to be seeking out information to be tracking some of the volatility in the market, what are your thoughts on where, speaking into my demographic, the 40-year-old somethings with families and jobs, we've not experienced this. We don't have the experience of living through some of these times. What are the things that we should be watching for that help us kind of shape our mindset and our thought process as we look to our investments? So kind of a two-part question there.
Well, I don't educate yourself. That's the first thing. We talk about financial literacy. We assume that people are good with money. In my experience, is most people aren't good with money. They've never handled money. They just don't know how to use money as a tool, and they need some education, and that's why we're there, is to educate them. One good thing we have right now is there's tremendous sources for information, but there's almost too much. Right. And with the 40-somethings, you guys all use your device, your phones and that. I really like Barron's. If you want a straightforward, and this isn't a plug for their magazine but Barron's is kind of the Bible of the industry. It's very good information. They have online accounts. I get the weekly Barron's. I think that's one place to start, and it's on a level most people can understand. But you need to try to educate yourself and talk with people. Come in and visit with us. We answer our own phone calls. We've got a whole team there of people that if it's money related, we can help you with it regardless. Will we always have the answers and will we always be right? No, nobody is. But I think we've got good things to offer. Maybe we can offer you some advice. If nothing else, maybe help you get your emotions into check. And I think that's the big thing right now is emotions are running pretty high, and we're seeing that. And that's always a tough time for everybody, advisors, clients. We understand that, but there's a lot of good things in there. The final thing, I'd leave you with this. When we get into this doomsday scenario, I've been through it in 87. I went through it in the dot-com thing, 99 when the banking collapsed, 2008, 9. I think when it all boils down to it, I always ask people, what's important to you? And most people, not all people, but most people will say, well, it's my family. That's right. Money is just money. I know it's important. I know it's your freedom, your livelihood, your retirement. But you got to think, when things get bad, what are the important things? They're your family. There's the, money isn't everything. And I think some people lose focus, and especially at this time, everything's money, 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 because they're all worried about their money. Right. So I think you have to look at, my grandkids, my wife, my family, those types of things, and maybe have a little bit of a reality check. Now, is that easy for everybody? No, and some people just can't do it. But we try to bring a little reality to it. But I would encourage people to call. Come visit. I mean, even if you don't have an account, we're happy to visit with you. We'll look at your current plan. If we'll tell you if it's a good plan, or we see a lot of good plans from other advisors, and we're not going to deep six it if they're doing a good job. And I think all the advisors are going through the same thing. We're all working for our clients' best interest. So that's kind of where we're at right now. So I think the best thing is communicate with us.
Thank you for that. And Jim, thanks for being on More Bank for Your Buck. One topic that we're going to probably ask you to come back and dig in a little bit more. We didn't get into it, but it's you talked a little bit about it. What's important to me, right? A legacy, family, grandkids, all of those things speak into this topic. So I'm going to have you maybe commit to coming back at least one more time. But that legacy, that tithing piece, how are we giving back? How are we using wealth to reinvest in our community in those areas that are important to us? We didn't touch on that today, so we'll circle back at another date with you on that. And then just to our viewers, he mentioned our phone number. We're going to put that in the comments under our episode so you know what number to call. EquitableOnline.com. We've got a link to our wealth banking team so you can see the team he was talking about and the resources that we've got to share, I think are important for us to mention here too. And Phil, I'll let you have the last word.
Well, Jim, thank you for being here today. I think in turbulent times like we're experiencing now, it's always good, like you say, even if you're not a client of Equitable Bank or Equitable Wealth Management, if you are nervous about the market, talk to someone. I mean, don't be ashamed to talk about the fact that you're fearful about what the market's doing and the turmoil and the volatility. Like you say, we're all in this together. No one is completely shielded from this. So I think it's been great to have you here to bring a rational voice to what can be a somewhat irrational time in the markets. But until next time, thanks for joining us on More Bank for Your Buck, where Erol and I will be discussing commercial real estate investing and how to get started.
I want to thank our audience for joining us today on More Bank for Your Buck, and looking forward to our next podcast together. Phil?
Sounds great. Thanks, Erol.
My pleasure. Thank you.